Jesse Livermore, perhaps the greatest speculator in American history, once remarked, "Patterns repeat because human nature hasn't changed for 1,000 years." He wasn't talking about magic or crystal balls. He was talking about the mathematical footprint of human emotion. Today, as we sit with the U.S. national debt crossing $34 trillion and the Federal Reserve struggling to navigate a higher-for-longer interest rate environment, many investors feel lost in the noise. They see the S&P 500 fluctuate and wonder if there's any logic left in the chaos. But what if the points where the market turns, those specific moments where a crash stops or a rally fades, aren't random? What if they follow a sequence discovered in the 13th century? Understanding how to use Fibonacci levels to predict market turns may matter far more to your portfolio right now than the latest headline on CNBC. Because what is happening beneath the surface of the U.S. economy right now may matter far more than most Americans realize. Let's look at the world we're actually living in. You feel it every time you walk into a grocery store. Even if the year-over-year CPI has cooled from its 9.1% peak in 2022, the cumulative weight of inflation is still there. For the average American professional, the math is getting harder. Mortgage rates have hovered between 6 and 7%, a massive shock compared to the 3% era we enjoyed just a few years ago. Meanwhile, U.S. household credit card debt has surged past $1.1 trillion. When you look at your brokerage account or your 401k, you're not just looking at numbers. You're looking at your time, your labor, and your future security. The volatility we see in the S&P 500 isn't just market movement. It's the collective anxiety of millions of investors trying to price in the next move by the Federal Reserve. If you value these kinds of calm visual breakdowns of the U.S. macro picture without the media panic, consider subscribing to Sketchy Man Finance. We don't do hype here. We do analysis. We focus on the cycles that govern our wealth. To understand where we are going, we have to understand the math of the universe. In the 1200s, an Italian mathematician named Leonardo of Pisa, that are known as Fibonacci, introduced a sequence of numbers where each number is the sum of the two preceding ones. When you divide one number by the next, you get a ratio, 0.618. This is the golden ratio. It appears in the petals of flowers, the shape of galaxies, and, crucially for us, in the way humans buy and sell assets. Serious investors think in cycles. They know that markets never move in a straight line. They move in waves. Think back to the 2008 housing crash or the 2000 dot-com bubble. When the market collapses, it doesn't just fall to zero. It breathes. It retraces. In the U.S. economy, we see this rhythm constantly. After the massive post-2020 stimulus and the explosion of the money supply, the market reached an exhausted peak. When the Fed began to squeeze the financial system by hiking rates from near zero to over 5%, the market began a correction. Technical analysts use Fibonacci levels, specifically the 38.2%, 50%, and 61.8 markers, to identify where those ledges are. These aren't just lines on a screen. They represent the exact point where the pain of a loss becomes an opportunity for a buyer. It is the mathematical boundary of human greed and fear. Now, let's apply this to the current U.S. macro core. We are at a critical juncture. The data tells a complex story. The 10-year Treasury yield, often called the world's most important number, has been a primary driver of market turns. When the 10-year yield spikes toward 4.5 or 5%, it puts immense pressure on everything from your mortgage rate to the valuation of tech stocks. Let's look at the S&P 500 through the lens of Fibonacci levels. If the market drops, analysts aren't just guessing where it stops. They're looking at the 61.8% retracement of the previous bull run. Why? Because that's where institutional liquidity often sits. Here is the analytical core of our current situation. The debt trajectory, with U.S. debt to GDP over 120%, the government's ability to save the market with more stimulus is limited. The core CPI, While headline inflation is down, core inflation, which excludes volatile food and energy, remains sticky. This keeps the Fed from cutting rates as fast as the market wants. The labor market. We're starting to see small cracks in the U.S. labor market. If unemployment begins to tick up, the psychology of the Fibonacci retracement becomes even more powerful as fear takes over. If inflation re-accelerates, scenario A, the Fed will be forced to keep rates high, likely breaking through those Fibonacci support levels and sending us into a deeper bear cycle. If inflation continues to cool, scenario B, those Fibonacci levels will act as a floor for the next leg of the bull market. I want to pause here and ask you, do you believe the Federal Reserve has truly contained inflation and we've seen the bottom, or are we simply in a temporary retracement before the second phase of this cycle begins? Let me know in the comments. I read them to gauge the sentiment of this community. At Sketchy Finance, we focus on understanding cycles, not reacting emotionally to headlines. But how does math in the clouds affect your life on the ground? For homeowners, your home value is essentially a Fibonacci extension of the last decade of growth. If the macro cycle turns, we may see a retracement in home prices. However, because supply is so low, this turn might look more like a stagnation than a crash. For 401k and IRA savers, the biggest risk to your retirement isn't a 10% market drop. It's the emotional exit. Most retail investors sell at the bottom right when the market hits a major Fibonacci support level where the smart money is actually buying. Understanding these levels allows you to stay disciplined. For fixed income retirees, rising Treasury yields are a double-edged sword. You're finally getting a return on your savings, but the purchasing power of that return is being eroded by the very inflation the Fed is fighting. The common thread here is liquidity. When the Fed pulls liquidity out of the system, the tide goes out. Fibonacci levels are the tide markers. They tell us how far the water is likely to recede before it starts coming back in. I'm not here to predict a total market collapse or a moonshot rally. The world is rarely that black and white. Instead, we live in the strategic gray zone. Serious investors don't gamble on what will happen. They prepare for what could happen. They focus on risk management and asset allocation. They realize that while the U.S. economy is resilient, it is not immune to the laws of mathematics. Using Fibonacci levels isn't about being a wizard. It's about having a map of the battlefield. It's about knowing that if the S&P 500 breaks a certain level, the probability of a further slide increases. It's about being an informed participant in your own financial future. If you value serious U.S. macro analysis without the hype, the red arrows, or the political panic, subscribe to Sketchy Finance. We're building a community of disciplined, informed investors who prefer data over drama. Cycles don't repeat perfectly, but they rhyme, and serious investors pay attention to the rhyme. I'm the Sketchy Man. I'll see you in the next cycle. The market is a device for transferring money from the impatient to the patient.